taxation of DeFi is not necessarily straightforward. As we heard from the speakers here, that it's a landscape that is evolving, it's developing, and it's also difficult for governments to keep track of all the things that are moving on, just as for the ones of us that is in this industry, because it moves so significantly fast. But however, how we at EY have been able to provide advice within the landscape of crypto since 2015 is that we rather have to do the thing that we have to pour the token out on the table, find all the attributes of that token and figure out all the specific elements, understanding all impacts of it, because not a token is not equal to another token. And by that, we can more or less pretty easy identify how it's supposed to be taxed, how it's supposed to be handled, but you also need to then cooperate together with local authorities in order to get clearance from them, because you don't have a written framework. So hence, within this landscape, it's very possible to get a pretty good overview, close to 100% of how you can navigate. However, you can just not read about it yourself. You need to look into it in a more thorough perspective. So many of these cases has, unfortunately, the boring answer towards each case has to be handled on a separate by separate case matter. But that's sort of where we are right now. But we have some corners, we have some indications towards it. So we will run through this one. So in many of these examples, there will be, call it, more questions towards it than core answers, but still I will give you some pointers and hints and tips towards what is at least very important to think about when you're dealing with DeFi and taxes. And some of the principles here is this way: document everything that you do and also inform about it. Lots of our clients and people we meet out in the field are saying, no, I will not disclose, then I just get a control. But I can assure you that if you receive a control, you will probably not receive that control from the tax authorities this year, because they don't have the competence. I've been working with tax authorities all over the world, and I've never, ever met any government that has more than a handful of people who knows crypto well. And by crypto, I mean just buy, hold, sell. Maybe they have one or two persons who understand DeFi and the more complex setup here. So hence, they don't have the resources currently, they don't have the tools, and they don't have the competence. Hence, they cannot perform controls on this one thoroughly, because then they would have to spend the resources of the whole crypto task force group and spend maybe a year on manual going through this one. So we see this one from assisting clients that are well known out in the crypto market. They receive a control, but the authorities normally would have gone 3 to 5 years back in time to look at their tax impacts. Now instead they go 3 months back because they don't have the resources. So right now, you will not probably receive a control, but maybe in 1 year, in 2 years, and 3 years. And then it's very boring to try to figure out what the heck you were doing with different DeFi protocols back in year X, Y, or Z. Hence, do not just trust blindly that you use a tool to extract your data from. You get your CSV files from an exchange or whatnot. But when you are into DeFi, you use typically not a centralized exchange. So hence you need to document everything. And by that, I mean, yes, probably it's on a blockchain, but still we see it from all the clients that we work with, that it's no tools out there that calculates DeFi correctly. So there's lots of manual considerations to be taken into concerns here. So it will save you lots of time and hassle by just writing down what you did as a reminder, and also possibly put it into a Word document, Excel sheet. It can be more extensively, more thoroughly, less thoroughly, but at least document what you do, because you will have a much easier case when the tax authorities show up on the control in maybe some time. And also down to these principles about that, you know, all crypto transactions have tax and legal implications. Lots of people out there in the market tend to believe that you can just play around with DeFi and go from one token to the other. Each of these elements has a tax element connected towards it. If you are in a jurisdiction where we have a capital gain or loss, then you are to calculate that one, even on stablecoins. We see it in the market right now. A stablecoin is not stable towards a US dollar, can be 0.97. Hence, there's micro volatility. People tend to forget this one. So that's a very important element that you need to take into consideration all steps when you just play and move around within DeFi, just in the same way as within crypto assets. And remember, if there's a gain, it's also a tax. That's just down to the principles. Even though that's not clear guidance out there, it will be for sure. So take that into consideration. And if you are in doubt, I would personally set off that amount so you would have it in place if you receive a control from the tax authorities. As mentioned initially here, Norwegian tax authorities, they were the first in the world to issue some guidance on DeFi and also now recently NFTs that we have assisted them on. And it was comments towards impacts of swapping. It was some specifications regarding how liquidity pool trading should be treated from a tax point of view. It was comments about governance tokens, etc. So we at least received some guidance from them, but there's not many governments all over the world that has given indications. But we should remember that this is not totally anonymous, you know. People tend to believe that, oh, they don't see us. This is just an example from Norwegian tax authorities who has identified exactly where all Norwegians live by cooperating with national security administrations also. Everything is identifiable. All countries all over the world has these maps, but they have not gone public with it. And they cooperate, of course, together with all of these clustering companies. So you can think about it, you can try it, you can try to be creative, whatnot, but governments sees what's going on, but they need to cooperate further with these private parties. They need to build the competence, they need to have more resources in, so it will take some time, but they will figure out what you have been doing within DeFi today and also in the previous years. So take that into consideration as a friendly reminder, not trying to be a party killer here. And also down to the market today, you know, we are now just around 4 million unique users of DeFi in general in the world. It's not a large market, hence that's also why governments are not necessarily focusing slowly on it. It's rather also down to that we will see, as we've heard initially here, I believe, that the volatility elements and that you see consumers are being liquidated or whatnot, and they think more about that protection part compared to where they were earlier, where they said, oh, 4 million users, that's practically nothing. We'll not even spend resources on this one. Instead, we have seen this significant increase, and then we will see more focus on it, both from the increasing part, but also from the consumer protection and professional investor protection side is my prediction here. So let's see on the mechanisms in general. This is just an example of MakerDAO using the example of DAI here and taking the principles into account. First step, when you go into DeFi, you have to go in and get some ETH normally if you're playing with the Ethereum DeFi ecosystem. And just to get the ETH, you might even have a taxable event because you could either have got that ETH from a previous swap. You could have bought it for a year ago, a day ago, whatnot. It can be then a capital gain or loss based upon the local rules in your jurisdiction. And you also need to keep track of here, like in Germany, if you keep it for more than 1 year and there's no tax, then you need to figure out whether or not it's the first one in, last one out, etc. All of these FIFO-LIFO principles that needs to be taken into consideration. So there's no such thing as a straightforward doing here. You can make it very difficult for yourself if you're trying to be creative. So just be aware that just the first step before you even have started to play around within the DeFi ecosystem, you can have taxable events. And also when you put an Ether in as collateral in a smart contract to lock it up, to get the DAI to play around in the DeFi ecosystem. That is, in most jurisdictions, it must all considered to be a liquidation. It's a realization. So you put it in there, and hence you have to calculate a capital gain or loss if that applies towards it. That's the first step. Then, of course, we need to see and understand also here from a legal point of view in terms of who is responsible for possibly the taxes inside the DeFi ecosystem. So that means who controls the smart contracts that runs the whole operating system here. And then we need to look into then, of course, the governance in general of governance token holders also. Who can be held liable for taxes, as we heard from the legal part there, because the legal part is connected towards the liability for a tax purpose. So one needs to understand if you are using this one, you could be held liable for taxes based upon ordinary tax rules that are in place already, just by being a governance token holders. Most likely you will not, but depending on what you have voted for, how you have stated, what kind of position you have, it can be for sure that governance token holders, even though that you just have 1% or one token, can be held liable for taxes that should be paid by a DAO, by the DeFi solution that is out there. So even if you're not in the development team, you can be held liable for it also. We will get a bit back to that one. And within this system, you see there's lots of complexity towards it. Also the AML, KYC measures that we heard that governments, of course, have focus on. So this is an area where tax authorities also, combined with other authorities, will look more thoroughly in. Because, you know, going from a euro to a ETH, put that as a collateral in, get a DAI, and play around, the first steps there are fairly easy. We can follow them fairly easy, going from the ETH in your wallet to the DAI. Then the more complex part is what is happening within the DeFi ecosystem, because you could put these money Legos and build your synthetics, your derivatives, your trading, your borrowing products on top of each other. And that's the complexity, where it can be hundreds, it can be thousands, it can be 10,000s, it can be millions of transactions that goes back and forth, back and forth. You have just put in some DAI, you are getting some percentages, then you get some DAI out, you exchange it back to Ether, and then you can possibly also go to fiat. These steps are fairly easy, sort of saying, but what has been happening in here? You also have an obligation for tax purposes to document everything you do. And that's not necessarily that easy either, even if it's on a blockchain, because it can be various different protocols that has been connected. Hence, back again to my principle, document everything you do as good as you can, because you will be in a much stronger position when you will receive a control of your accounts from tax authorities. So principles in general here, just to summarize, is that it might be a taxable event in terms of capital gains loss when you put in a collateral. That's considered to be a liquidation. Then, because of the principle that you go from a wallet that you control de facto to a wallet that you do not control. You do not control de facto the smart contract because you have locked it up as a collateral. You cannot just freely take it out. It's based up on the pawn breaker principle. You have to pay it back. If you pay it back, you will get it back, but then you will get a new input value. For tax purposes, that's also very important. You might have bought the Ether for, say, just an example, $1 when you got in, but when you get it back, it might have the value of 100. Then you have a new input value. The input value for further tax calculation is not 1, but then 100. And then the same principle here also. Remember, when you get a DAI, that's a new input value for it. That's normally a 1-to-1 towards the US dollar, but still it can be micro volatility, so it can also play a role there. So that's just the basic principles in terms of taxation here. But also a creative element that we have seen from several of our clients is that you can think about it in many of these DeFi algorithms. You can put in and you stake more, you put in more collateral than you get DAI. So you put in, for example, 150% collateral and you get 100 DAI. Some you can even put in 200%, or you can create your own by setting up, I need to put in 1,000% of collateral while getting 100. Think about, for tax purposes, for the countries that have wealth tax. I've received several questions from my DeFi clients on that. Magnus, I would like to reduce my payable wealth of the crypto assets that I have. Can I lock up then 200% of them in the 31st of January Just put it into a DeFi mechanism, get 100 out, reduce it by 50%. Then on the 1st of January, then I just swap it back, get it all back, and I have withdrawn sort of the wealth tax. Well, that's tax evasion if the tax authorities can prove it. I would not recommend it. But if you put it into a DeFi algorithm, and we've checked this with the authorities, and you're actually playing around with it, you use it, you have the intention of doing it, well, then it might be legit. But don't try quick fix solutions here, because that will be considered as tax evasion. And also remember, in this one, the DeFi ecosystem is more than people are talking a bit about, yeah, DeFi, NFTs, cryptos in general, but they're all sort of same active classes. They're all within the same framework. You use cryptos in the DeFi ecosystem, and you use now also NFTs in the DeFi and crypto system. And that we clearly see now, as we've seen people are using NFTs as collaterals also. Remember that one. If you borrow out NFT, for example, now NYC NFT is coming up. Lots of people wants to go to the ape parties, of course, but they don't have an ape. Oh, you can just borrow mine. You can borrow mine. I'll send it to you. Well, if you send an NFT to someone, that's a taxable event. A capital gain loss on that one as well. If you borrow it out, if you send it to a friend, if you're renting it for a weekend, if you're renting it out, it's a new input value coming in and a new input value going out when you receive it back based upon the fair market value. So remember, playing around with these funny things is not just something that you can do. There's always taxable events relating to it. And also regarding this one, the kids, we've seen all these examples within the DeFi and NFTs that this is just some examples. And both parents, they have no clue what the kids are doing, but they forget that it's taxable events on all the things they do, not only on the development side, but of course also if they are playing a game, play to earn, having a skin, a sword, whatnot for a game. They're buying it, they're holding it, they're selling it, they're lending it to a friend, all the same principles as with an NFT, as I mentioned. Taxable events all the way, which you as a parent are liable on behalf of your children. So maybe one should shift focus also from not only trying to monitor what your kids are watching on TV or the internet, but rather what they're actually doing within the gaming world when they're dealing with crypto assets, because it can have huge tax impacts based upon the values there also. And down again, just in the end here briefly, about who is responsible for this money Lego landscape. There's no clear indications directly towards who is responsible, but we can apply principles that is already out there in the existing ecosystem. And we've also received indications from the FATF guidance, etc., and several others who have given hints towards who can be held liable. That can be the developers, can be the DAO foundations, it can be the governance token holders, and in some instances also the users. Because governments will just apply basic principles towards this one. It's easy math. There's no such thing in the world as decentralization today. Forget the D in DAOs, in dApps, and DeFi. There's a physical person behind this one. It might be hard to find that person, yes, but still the smart contract has not been created out of the blue. Sorry. So who started this one is one of the questions they will look into. Who owns the website? There's always a website. Yeah, it could be registered as a trust for that sake, but still, it's a physical element. And who is running the Twitter, Telegram, Discord, all the social media setup? And who is actually controlling the private keys to the smart contract? That is what FATF has said, who is most likely liable for the whole thing here. And that could be the foundation. The people in the foundation could just have been delegated a role on behalf of the governance token holders, of course, but still governments can go in and say, no, you, Mr. or girl, you can run away with the smart contract code and take all the assets. You are de facto also responsible. So down to who the wallet holders are, who has the voting rights there, etc. And another thing for tax purposes that we clearly see there's lots of errors on is in terms of Something is written in your white paper, something is written in the terms and conditions, something different is written in the smart contract, something different is written on the web, something different is written on all sorts of other social media. So in terms of being able to classify the attributes of the token, of the principles, one needs to understand this one from lots of different angles in terms of how governments also will address this one. So if you don't have consistency towards this one, you are of a high risk, either as a developer or as a user of our protocol, because governments can suddenly go in and say, there's clearly an element where you have sold an electronic service in some kind of way here, should be a tax on it, a sales tax, VAT, whatsoever. It could be reporting obligations. Suddenly the DAO or the DeFi solution is responsible to report the tax for all the governance token holders and find out where they are. Governments will not trace down all governance token holders then. They will rather go to the DAO Foundation or the original developers if they can find them. Hence, that's where they will also look into your role. If you do something for a DAO, for example, employment fees, taxes that should be paid in that relation. And also, of course, they will look into the aspects here of the consumer rights, money laundering, KYC, all of these elements, if you don't have these in place, which all can affect the taxable position of the company. So in general, there's lots of things that needs to be taken into consideration when you're dealing with this one. So I do not want to only be the party killer. I would rather say we're here to help, to assist, to build this system together, to build this landscape. Right now, it's a bit unclear, but in general, we at EY believe that the mechanisms of DeFi, not necessarily all the protocols that is out there right now, but the mechanisms of DeFi will 100% sure be the mechanism and future of finance in general going forward. So that's why we have said within 2030, we believe that more than half of all new business contracts out there will be done on a blockchain executed by a smart contract. So once again, we are definitely not the party killer, the party stopper here, but we want to create the clarity, and we can do that one, but then you have to also look thoroughly into each case by case matter, and then you can get the clarity. So that's unfortunately the boring answer where we are right now. So if you have any further questions, I think we can take that in the Q&A session, but also feel free to connect with me on LinkedIn or other social media. And by that, I thank you a lot for the attention.